Hello, I'm Edward Ingram, and I'm going to tell you about some very interesting stuff that might affect the whole economy, and it might be of use both now in helping with the financial crisis and in the future. Sounds a bit grand, so let's come down to earth. How would you like it, speaking here to the cameraman who hasn't heard this before, how would you like it if I could offer you a mortgage in the USA or the UK or some other place, or South Africa, and this mortgage, you would find that the payments became easier every year for a person on average income. After 3 years it would be 12% easier in terms of cost to income for an average person, and it would go on declining every year by 4% per annum. It would never jump up or down unexpectedly. You would know in advance how much your mortgage would cost in terms of the total income, and in terms of what you've borrowed, you'd know how many incomes you've borrowed. How does that sound? Would that appeal to you? Would that appeal to you? Yes.
Yes, it does.
It does. Because what happens nowadays is that you take a mortgage, it's variable rate, and your payments jump around. You ask, how much will it cost? They'll tell you. You say, how much will it cost next year? They can't tell you. If you take a fixed interest mortgage, either it's too small to give you a decent mortgage, but because of inflation it rapidly reduces in cost, or you don't have inflation and it hardly reduces in cost at all, and it really is a pain to you, as for example now in a recession in America. It's also a pain to the person who lends you, because they don't know how much wealth they're going to get from you. They know how much money they're going to get, but they don't know what that's going to be worth. With my system, everybody knows exactly where they stand. And this is called the Ingram lending and savings system, because it looks after the savers and it looks after the lenders. There's also a variable interest rate version of this, and this can be used, and it has very similar characteristics. It's just the difference is that we don't know whether it'll go down every year by 4% per annum. But we can start at that figure, and we can be very sure it'll never actually go up, because the only way it could go up would be if interest rates went so high compared with inflation that it's unsustainable, and the lender would be absolutely flooded out with people wanting to lend money, putting it on deposit with them. So that's the variable rate mortgage system. Now, how would you like it if the regulator ensured that the lenders could not lend too much or too little using these systems? Because if you lend too much, then it won't be 4% per annum, it'll be 2% per annum or 1% per annum, and not everybody will be able to keep pace. And if you lend too little, then you're not really going to be able to buy the house that you want. So there is actually quite a narrow range within which the regulators should allow the system to operate. And in fact that's also true of the current systems. It's just that the current systems are not regulated in that way, which is a great shame, because that's what produced a large part of the housing crisis and the banking crisis and the world recession. The lack of that regulation. So I've designed a mathematical arrangement which enables the regulators to determine what limits the lenders should be allowed to operate within, and I would like that to be adopted. If we adopt that, then lending will be a lot more efficient and a lot less burdensome for everybody, because the lenders won't have to have such huge reserves as they've been told they've got to have in order to protect themselves from house prices crashing and mortgage payments crashing. Those things won't be happening. So they don't need that level of reserves. And this is something that's been commented on by all the bankers that I've spoken to and shown what I've done. So that will also help the world economy if it was to be put in place now. So you can see that under this arrangement, you would know that what you had bought in terms of a home would stay in value reasonably close to the value that you were given when you bought it. The lender can see that the collateral security he's got by virtue of lending you something to buy something of value. He feels safe and he can reduce his interest rate because he's not taking a big risk. Neither is he taking a big risk on your ability to pay. The only question is whether you'll keep your job. Well, lenders have always had to live with that problem. And when the economy is behaving itself reasonably well, that risk is relatively low. It doesn't really cause a problem. Not to the lender anyway. So I think you can see that if the economy was running that way, it would be a lot easier for the economy to be managed, and your wealth and your savings would be a lot safer. So I thought that that might be of interest to you. What do you think? What?
I think it's a brilliant idea.
You think it's a brilliant idea?
How are you calculating? What about the mathematical question? How are you calculating it?
How am I calculating it?
Yeah.
Well, there's a lot of mathematics involved, and it took me till the mid-1990s to solve that problem. But I was mostly busy running my business up until 1992.
Okay.
But I've got an extremely sweet and simple mathematical analysis, which has been looked at by the Institute of Actuaries in London. And one of the fellows of the Institute said that he was very impressed with this. In fact, he went further. He said, because I explained the economic consequences to him, he said to me afterwards, "I'll never forget this day." Yeah. So the plan at that time was to sell the intellectual property to banks, but they weren't interested. That was a problem. They were lending too much. They didn't want something like this that would restrict their lending, although it's capable of lending a whole lot more. In fact, that brings me to another point. At the moment, the banks are very vulnerable. They're vulnerable because property prices are unsafe in the USA, especially in Spain, and also in the UK. And that's a large part of the developed world's economy that's got unsafe banking, unsafe property prices. Now, normally under my system you'd be able to borrow about 3.5 years income, which is about typical of what people used to borrow. Now, if we were to stretch my system and give you a fixed interest loan and reduce the payments by 2% a year instead of 4% a year, and we had the interest rate set a little bit lower than the long term. Well, interest rates are low now anyway. So my opinion is that somebody, maybe pension funds, maybe the government, would be very interested in a system in which you borrowed 5.2 times your income and paid back something like 5.8 or 5.9 times income over a 25-year period. Because if that was made available, and we can make it available using our system, then what happens is that people can now afford to buy those houses, and they've got the guarantee that they'll be able to afford it into the future, provided they keep their jobs. And the banks now have value. Those properties now have value, which is underpinned by the fact that they're now affordable. So this isn't something for the long term, but it might get us more or less started in getting out of the recession, because the banks are now much more secure. They don't need so much money to prop them up, and the property values are safer, and people are feeling safer, and their budgets are safer. They know they don't anymore have to worry what will happen after the recovery. Will my mortgage become unaffordable? It's already defined what it will cost. So we can move gradually from that situation, from that arrangement, back to a normal arrangement where you're only borrowing 3.5 times income. But we can't do it this year or next, but we can ease into that. And we can, in the process, if this plan was to be adopted and financed by, who knows, maybe the government or one of the governments, maybe the pension funds, maybe a partnership, if this plan is adopted in that way, it might just give people the confidence they need to believe in the economy, which would push up share prices, which would make them feel wealthier. They'd feel happier about their wealth and their properties. They'd be happier to start spending money a bit faster, and businesses would start feeling stronger that they could afford to borrow and invest and expand the economy and create jobs, and that would result in an upward spiral. The economy would recover. It only takes confidence to make an economy recover, but the confidence has to be justified. So how does that sound? Does that sound as though it makes sense?
Yeah, it does make sense. However, I don't know how people are going to take it.
Well, let's see what they say when they see this video. Let's hope that we get some feedback.
Yes.
I would like ordinary people to buy into this. I would like them to say, yeah, this is a mortgage scheme that I would like. And I would also like the government to reconsider how they arrange their borrowing themselves. I'm not going to go into that in this session. We'll do that in another session. But basically what I will be saying is that if the government makes their borrowing as safe as the mortgage borrowing, then and by using a similar arrangement, which they can easily do, then this will cost the government very little, and the lenders could be your pension funds and your savings. You could be buying government bonds and have the wealth that you've saved preserved. And I'm not talking about preserving purchasing power. I'm talking about preserving the income that you saved. Remember what I said, with this mortgage, you borrow 5.2 years income and you pay back 5.9 years income. That doesn't mean that incomes are not outstanding still. It means that what you've borrowed is that much income. The person who's lent you 5.2 years income will be able to spend 5.2 years income themselves, not allow you to spend some of it because you didn't pay back enough. And they'll have a little bit more money to help to pay the administration costs. Now that's very cheap lending. It's for now, it's not for always. That's the market and the way the market is now. But it will change, and you won't be able to borrow 5.2 years income forever under this system. I think people will want more than 2% per annum easement, and I think 4% is about right, judging by what's happened in the past in the UK. So that's all I have to say at the moment, and I think that, well, basically if your wealth and your pensions and your budgets and the government's budget is underpinned by a system like this, then we can really start talking about having an economy that's easier to manage and a whole lot simpler to understand. Thank you.
You're welcome. Thank you.